Ever wonder how a simple stock split could shake up your portfolio? Well, SCHD just dropped a bombshell, a 3-for-1 stock split, and trust me, this is huge news for investors. SCHD, one of the most popular dividend ETFs, is making a move that could boost long-term growth, increase accessibility, and attract more investors. But what does it actually mean for you? Stick around because in this video we're breaking down what a stock split is in the simplest terms, why SCHD is making this move right now, how this could impact your investments, and whether now is the right time to buy. Hit that like button, subscribe for more investing insights, and let's dive in. Alright, let's start with the basics. A stock split is like cutting a pizza. If you slice it into more pieces, the total size of the pizza doesn't change, you just have more slices. SCHD is doing a 3-for-1 stock split, meaning for every one share you currently own, you'll get 3 shares. Sounds amazing, right? But here's the catch. The price of each share drops proportionally. For example, if SCHD is trading at $84 per share now, after the split, each share will be around $28. But don't panic. The total value of your holdings remains the same. It's just divided into more shares. So why do companies even bother doing this? It makes shares more affordable for new investors. It improves liquidity, making it easier to buy and sell. It attracts more investors, which can drive demand and long-term growth. Simply put, a stock split doesn't change a company's fundamentals. It just makes it more accessible. Timing is everything with stock splits, and SCHD picked the perfect moment. In the past year, SCHD has grown by 18%. That's solid performance for a dividend ETF. On top of that, they just announced a 15% increase in their quarterly dividend. So why the split now? A lower share price means more retail investors, people like you and me, can afford it. More investors equal to more liquidity, and it is becoming a less volatile stock. Lower price stocks often attract more demand, which can drive the price back up over time. This move is all about fueling future growth, making SCHD even more attractive heading into 2025 and beyond. Alright, so what does this mean for your portfolio? First, the total value of your investment won't change. If you own 10 shares today, after the split, you'll own 30 shares, but at a lower price per share. Your dividend payments stay the same in total, just divided across more shares. But here's where things get exciting: dividend reinvestment. More shares fuel more dividends. More dividends equal to more reinvestment. More reinvestment equal to faster portfolio growth. This is called the snowball effect, and for long-term investors, it's a game changer. So should you buy before or after the stock split? Short answer, it doesn't really matter. If you buy now, you get fewer shares at a higher price. If you buy after the split, you get more shares at a lower price. But either way, the total value of your investment is the same. What's important isn't when you buy, but how long you stay invested. SCHD has strong fundamentals, solid dividend growth, and long-term potential. So if you believe in SCHD, the smart move is to buy when you're ready and start letting your investments grow. So what's next for SCHD? They've delivered 18% growth in the past year. They just raised their dividend by 15%. And with interest rates lowering, ETFs like SCHD could see even more capital flowing in. SCHD's stock split is more than just a number change. It's a move to make the ETF more accessible, attract more investors, and fuel long-term growth. Whether you already own SCHD or are considering adding it to your portfolio, this is a big opportunity. So what do you think? Are you buying SCHD before or after the split? Let me know in the comments. And hey, if you enjoyed this video, don't forget to like this video, subscribe for more investing insights, hit that notification bell so you don't miss future updates. Thanks for watching, and I'll see you in the next one.